So, is the stock market, our investor appetite set up to be risk on, or are we going into risk off? Mr. Dan Bird has put some charts together. We're going to see what's what. I'm no idea. Let's go.
Neither do I.
Well, that's honesty for you.
No,
That's
nobody does.
why we play the game, folks.
But we may be on the precipice.
Ooh, precipice. There's the SAT word.
We may be. We may be right on the edge of going one way or the other.
Okay.
I think the next 2 weeks is going to tell us. Actually, the next 2 weeks, well, we'll get into it, but the next 2 weeks is the most dangerous time. I'll put it that way.
Got it.
And then if we are going to have that end of year rally, it should start after 2 weeks. And if we're not, then it won't. It'll keep going down.
Okay.
Which is rare, by the way. It doesn't often happen. If you remember back in the beginning of the year, Stock Traders Almanac has an indicator they call the Santa Claus rally, or the January effect.
I remember.
January effect is three things: the Santa Claus rally in December. It's the first 3 trading days of January, and then there's the whole month of January. Mm-hmm. And if each one of those is positive, then, in fact, I don't think there's ever been a year that it's missed. It might be one year that it missed, but the end of the year is higher than it started in January. And all 3 of those hit this year. So we should end higher than January. That doesn't mean we'll end higher than we are right now.
Okay.
All right. So let's take a look at a few things. If anybody would like to get the newsletter, just go to breakpointtrading.net and you can download it straight off the website for free. No credit card asked, no registering or anything. If you want to sign up for all the other stuff that I use, and I'll show some of the charts from, then there is a subscription involved in that. But if you just want the newsletter, just go there and download it for free. So let's take a look at a few things. So there's some new charts that I created. Earnings are coming up. We talked about before. We just really started with the big banks. JP Morgan reported some really good numbers. And they took off initially, but it pulled all the way back. In fact, it was actually negative at one point on Friday. Mm-hmm. So I don't know if that's just following the market, but they actually had some pretty good numbers. So we'll have to watch and see what happens. So one of the ones I just created is called price to earnings ratio. This shows you the price to earnings ratio for the S&P. This gets talked about a lot, so I thought I'd create a visual just to see. People say the market's overvalued, the market's undervalued. Sure. Earnings can't go up anymore because they're already overvalued. So this chart right here kind of shows you what the normal range is in between these 2 dotted lines. And right now it's at 2391 is the PE ratio.
Okay.
So if it gets up above 25, that's definitely overvalued. And if it gets below, say, 19, that's very much undervalued.
Okay.
But that's where we are right now. We're just a little bit on the upper end of that. And then the one on the bottom is the actual earnings. When they come in, you can see in 2020 with COVID, earnings dropped off considerably. In 21, when the market really zoomed higher, earnings took off. So earnings always drive the market. And then in 22, when we had the bear market, earnings were flat for a while until about April or May. And then earnings started dropping off. And ever since the beginning of this year, they've been slowly creeping back up a little bit higher. So what does that portend for earnings season? Now, I think the estimates, the forecasts from a lot of companies and a lot of analysts have been drastically reduced.
They have.
A lot of it because of the bear market in 22. And I think because of that, a lot of companies are going to beat their earnings. So earnings may actually come in better than expected. There's another way to look at this. This is from VectorVest. So they have an earnings indicator chart. And this goes back to December of 21. So you can see all through 22, earnings were dropping, declining, declining, declining.
Okay.
VectorVest says if this gets below zero, then the market is in a bear market. This is a long-term view here. Mm-hmm. Market's in a bear market. It never showed a bear market. It got all the way down here until around June. It just flattened out until just recently in August. And it's been slowly creeping up since then.
Okay.
And you can see CPI down here. CPI dropped off and CPI is starting to creep up a little bit. Mm-hmm. And then this is the 50-day moving average of earnings, of actual earnings.
Got it.
And that is creeping up as well. So this line up above is a long-term view of earnings, mm-hmm. and it drags this green line. Whichever direction this goes, it will drag this green line. So even as it dropped right there, the green line came down, but then it just flattened out, and now it's creeping up. So that implies that earnings are going to be better than expected.
Okay.
And earnings drive the market. So that's one thing to look at as far as risk on, risk off. I actually created a risk on, risk off chart. And what this shows is, so here's the S&P up above. Here's the bear market of 22 till October. October is where the bottom was. First one is stocks versus bonds. So you always want to see stocks outperforming bonds, right? If it's risk on. And right now it is decidedly stocks are outperforming bonds. And a lot of that is because of the rate hikes. You know, people are not getting into bonds, which is driving the rates higher, the yields higher. But if they start buying bonds, if the Fed starts to drop rates at some point, mm-hmm. and then people start buying bonds, then the rates are going to drop dramatically. But right now, stocks versus bonds indicate that it's still risk on. The next one is investment grade corporate bonds versus 7 to 10 year treasuries. So these are for more long-term traders. They will move to investment grade corporate bonds if the market is moving higher, and they'll move to safety if it's not. So in general, this has been moving up, except for just recently it ticked down a little bit. I don't know if you can see that right there. Mm-hmm. And by the way, this is a weekly chart. So each one of these is 1 week. Ticked down a little bit, but it's still above, where it's been for most of this year. So that is, to me, still says risk on so far. The next one is high yield corporate bonds versus 3 to 7 year treasuries. And that one's been moving higher. In fact, it's higher than it's been for this whole 3-year period. This period, actually, this is a 2007. This goes back to. So you can see the recessions there as well. So high yield corporate bonds versus 3 to 7 year treasuries. That one's higher than it's been through this whole period. It's come down a little bit as well, but it's still higher than it's been through the whole period. The next one's really interesting: growth versus value. So this is if traders are moving into growth or rotating into growth and away from value, this line will go up. And that's what's been happening since the beginning of this year. And in fact, it is still ticking higher. So even though the market has been coming down for the last 2 months, big traders are still rotating into growth. They're positioning themselves for a rally. Now, if we look at 21, because this was really telling in 21, that the last quarter of 2021, and we talked about this. In fact, when we first started these, it was in December of 21. Mm-hmm. And I think this is one of the things I talked about, that it looked like growth, they were rotating out of aggressive and into defensive sectors, even as the market was hitting new highs.
I remember.
So that was the indication that, that Wall Street was setting up for a big decline in 22. Even as the market was hitting new highs, they were rotating out of growth and into value. And you can see a big, huge drop off right there at the end of December. Mm-hmm. But right now, it's the opposite. Right now, the market's been going down for 2 months, but they've been rotating into growth as the market has declined. So that to me indicates risk on. And then finally is discretionary versus staples. Discretionary are things we want to buy. Staples are things we have to buy. Again, you can see here in 2021, as the market was hitting new highs, this one was really clear in the last quarter of 21. It's actually from November until January. As the market was hitting new highs. So that's the thing you have to remember about this end of 21 period. The market was hitting all-time highs consistently. Day over day, week over week, the market kept hitting new highs all the way till December, the end of December. But look at discretionary versus staples. Through that whole period, big traders were rotating out of discretionary and into staples, getting ready for a big sell-off. And that's what happened in 22. We had that big bear market in 22. So where are we now? Well, it looks like they're still rotating into discretionary and out of staples, even as the market has gone down the last 2 months. So to me, that indicates risk on.
And again, these are weekly charts, right? These are weekly.
These are weekly charts, yes.
Okay.
So we'll take a look at this breadth analysis intramarket. So here's the S&P. Ever since August, it's been declining. I showed this channel in the last session, but this is the S&P declining. It hit twice. It hit this top level and went down, but this last time it started down Thursday and Friday last week. It started down before even getting up here. In fact, it started down after hitting the 50-day moving average. So that's not a good sign. But let's look at the intermarket relationships as this whole period from August till now. So here's the NASDAQ versus the S&P. So you would expect, the NASDAQ should do well if the market is going to go higher. NASDAQ is risk on, S&P is risk off. Think of it that way.
Okay.
Basically gone sideways as the market has declined. So it didn't go down, but it didn't go up either. It just went sideways. So traders are just treading water, waiting to see what's going to happen. But look at growth versus value. It has been going sideways ever since this August period until the beginning of October. And now it's broken out. So clearly, traders are rotating out of value and into growth. All right, that's a clear breakout right there. Discretionary versus staples. Now this one has a slight uptrend, and you can see that it got to the top of the trend and reversed last week. But it's still within this basically sideways movement all through the same period when the market's been going down. So all of those tell me that big traders are either waiting to see or they are positioning for a rally at the end of the year. Now, these last two could throw a lot of water on this theory, this thesis. Okay. This is mid cap, small cap.
Yeah, that's not a good chart. That's not a good chart for that risk on, risk off.
Right. Mid cap and small cap are doing terrible. So what that says is,
I wonder if this is really just a sign of interest rates kind of eating their way up the food chain, right? The biggest of the big boy, the Magnificent Seven, print cash, they don't have to borrow money, but the small caps,
yes,
they get hit really hard.
Yes.
Then it's the mid caps next.
Yes.
Maybe it's just
working its way up. That's a very good observation, actually. That may be the case. We'll have to watch to see how this does. Now, the next 2 weeks are going to be critical. Yeah. If all these three on the top start to roll over and actually break through the bottom of this channel in the next 2 weeks,
then it's look out below, right?
Then it's risk off. It's clearly risk off. I've already talked about this 200-day moving average.
Yeah, that's a big one.
We got to watch for, which is the bottom of this channel. So all of this says right now, it looks like risk on, but there are some cautionary signals.
Well, can I just twist that a little bit? I think it
Sure.
says risk on for the top 50 companies and risk
Yeah.
off for everybody else.
Yeah. I don't disagree with that.
Okay.
Yeah. I think that's probably true.
Okay.
And in fact, that brings me to the next chart that I created. And this is one as a result of an email that one of the subscribers sent me
Oh,
from
nice.
another site. And he basically was saying the same thing, that if those magnificent seven fall apart, then the whole market's going to fall apart. And that's the advanced decline lines.
Okay.
So this is, I did it for three indexes. This is the New York Stock Exchange, the NASDAQ 100, which are the 100 largest companies, and then the NASDAQ.
Okay.
And the website he sent me only used the advanced decline line for the NASDAQ.
Hmm.
Okay. It's one of the issues I have with a lot of websites out there right now. And it's the reason I put in my newsletter at the very last, let me see, where's my newsletter? Well, I'm going to bring it up again. The very last line in the newsletter. It's always critical to separate fact from fiction. Now, that's not my line. That actually came from right here, from this article that I put in here, which is pretty interesting as well. This talks about the federal debt and total debt to GDP. You know, it's not as bad as everyone's making it out to be right now. But it's important to understand when you see anything from another site, like the advanced decline line in particular, it's important to put it in perspective. And I've always said that on this channel, put things in perspective. So there's the New York Stock Exchange, the NASDAQ 100, and the NASDAQ. This explains the advanced decline line for the NASDAQ. This is what I sent to that subscriber. So you have to understand where the advanced decline lines come from. So now I'm going to scroll down and actually show you the advanced decline lines for these three indexes. And look at the one for the NASDAQ in particular. So in that email that he sent me, the website that he was referencing only showed the NASDAQ line and said, you know, the market is falling apart. All of these companies are declining. It's the Magnificent Seven are the only ones holding it up, and which may be true, but it's a little misleading to only show the NASDAQ advanced decline. And the reason is, and it's explained up here, NASDAQ is full of upstarts in industry ranging from biotech to technology to alternative energy. There may be huge upside potential, but there is also risk of absolute failure. This means more NASDAQ stocks are prone to delisting. Companies that fail are removed from the index and replaced, but their negative effect on the AD line remains. So the NASDAQ advanced decline line very many times will decline even though the markets don't. Now, it may still be the same issue that you mentioned. A lot of those smaller companies are going out of business because of the rates, right? They're declining for that reason.
Absolutely.
But will that then make its way up into the larger companies? We don't know.
Well, I think if my 2-minute theory has legs, it will work its way up to some point.
Yeah,
and
to some
stop.
degree. To some degree, yeah.
Yeah, because there's some company, like if you print cash or you have stock war chests, you don't need to go to the market to borrow.
Right.
You're self-funding. But it will clearly take out the zombies, the highly leveraged, and it's just started.
And that's what the NASDAQ advanced decline line, that's exactly what it's telling you.
Yeah, it's just taking them out to the woodshed and saying, see ya.
Right.
Yeah.
It's taking out the zombies. So you have to understand how these things are calculated, not just look at the NASDAQ advanced decline line by itself and say the market is falling apart. The thing to watch is whether these two lines start to come down. Now,
Mm.
if we look at where the bottom of these were, so the New York Stock Exchange was down here, right at the bottom in
Makes
October
sense.
of 22, right? Yeah, that makes sense. That's when it started coming up. It's still well above that. In fact, it's still well above the March lows.
Mm-hmm.
It's even above the May lows. So that's the thing to watch. In
Okay.
addition to that one that I showed you before, to see if they break through the bottom of that channel, that will
Mm-hmm.
tell us whether those are moving up
Yep.
the capitalization stack,
Yeah. Cap stack. Yeah. Yep.
cap stack.
Okay.
We'll watch these to see if they break out through the bottom of that. But then also watch this to see if the advanced decline line starts to break out at the bottom. So the next 2 weeks, I think, is going to tell us one way or the
Well,
other.
I look forward to talking to you the next 2 weeks. It's going to be interesting. Show the website one more time.
Sure. If anybody wants to get the newsletter, I had most of this. I didn't have all of those charts because I just created those recently. But most of what we talked about is in there. Just go to breakpointtrading.net, and right from the website, you'll end up on the main page, and this little box in the upper right. Here's the home page right here. Little box in the upper right. You can click there for the newsletter. It's free.
Yep.
There's also some free charts here on the main page, the S&P, so you can look at each one of these.
Mm-hmm.
This is Stock Trader's Almanac buy signal when that MACD crossed right there.
Yep.
So I put it right on the main page so you can watch it. It has not crossed back over, by the way. So you can see how, again, since August, the S&P has just traded sideways in this range.
Yeah.
So again, the 200-day moving average at the bottom is absolutely critical.
Well, we will be watching. I think the next 2 weeks are going to be a lot of fun. Dan, thank you so much.
You bet. Have a great week.
You too.